In my last blog, I introduced the concept of active management and compared that to asset class management and index management. Now today I want to look at the pros and cons of active management or active asset allocation, as it were. About 70% of all the managers out there in the world use active management as their preferred methodology. But let's see how they're really doing. The percentage of active public equity funds that have failed to beat their index is shown on this slide. Starting at U.S. large cap on the left, 75% of active managers failed to beat their relevant index for the 5 years ending December 2012. If you'll notice, they're all very high failure rates, except you might say, well, what about international small cap stocks? Those managers did quite well, where 80% of them beat their index counterparts. But what we did is looked underneath the covers there, and we realized that many of them were actually investing in emerging market stocks. So when you adjusted for that, they too were right up here in the 70% range of managers failing to beat their index. Same story, different verse for fixed income. Again, 5 years looking back from December of 2012, the vast majority of the different types of bond index managers, from governments to corporates to munis, failed to beat their index. Did a little better here for this 5-year period for investment grade intermediate term, but as a portfolio, that's the only one that had better than 50-50. More important than looking back and how they did, of course, you and I want to know, well, how have they done if you could identify them and then look forward? So we looked at the winners over the 3, 5, and 7-year periods. As you can see, about a third of these managers over the 3-year beat their index. But then we looked subsequent, the next 3 years. And importantly, these winners did not continue to beat their index counterparts. In fact, only 26% of the 1,189 funds continued to win in the next period. And from the 5 years to the ensuing 5 years, it happened again, 26% over the 7 years from 03 to 09. And then we looked at it again, 23% of the fewer and fewer funds, 1,100, 900, 597 funds continued to win. So there's no evidence that even if you pick a winner, that it will continue to win going forward. The story's the same for the fixed income. Winners are few to begin with, and then if you look to the next period from 07 to 09 and then looked forward from 2010 to 2012, the winners splay out, if you will, and less than half of them continued to win. Same for the 5-year period, less than half, and just over half continued to win going forward. There's no evidence that if you keep working at it, you're going to pick the next winner by looking at the past winner.